In a world of digital transactions and fiat currencies, a glimmer of the past still holds the key to our economic future. The global economy teeters on the edge of a precipice, while an age-old solution waits in the wings. Today, we're diving deep into the controversial world of gold, central banking, and the potential collapse of our current monetary system. Let's start with a fundamental contradiction that's hiding in plain sight. The Federal Reserve, our central bank, sets interest rates, but here's the million-dollar question: isn't this essentially a form of price control? Think about it. We're told that free markets are the most efficient way to determine prices. Yet, when it comes to the price of money itself, the interest rate, we rely on a small group of people to make that decision. It's a glaring contradiction that many economists seem to overlook. This contradiction lies at the heart of our current economic system. On one hand, we champion free markets and their ability to efficiently allocate resources. On the other, we allow a central authority to manipulate the most fundamental price in our economy, the price of money. This isn't just a minor inconsistency, it's a foundational flaw that undermines the entire premise of our economic structure. Now, let's talk about gold. You might think it's just a shiny metal for jewelry, but it's so much more. In fact, I'd argue that gold is still the foundation of our entire monetary system. But wait, you might say, we use dollars, not gold. True, but here's the thing. The value of those dollars is ultimately tied to gold. Don't believe me? Let's look at the numbers. Since 1971, when the US officially abandoned the gold standard, gold has outperformed virtually every other asset class. This isn't a coincidence. It's a clear indicator of gold's continued relevance in our financial system. While we may not explicitly use gold as currency, it serves as a silent backstop, a constant reminder of what real, intrinsic value looks like in a world of printed money. The relationship between gold and our modern currencies is more than just a historical artifact. It's an ongoing, dynamic interplay that shapes the very foundation of our global economy. When uncertainty rises, when currencies falter, investors flock to gold. This isn't because gold is particularly useful in an industrial sense, but because it represents something our fiat currencies can't, a store of value that exists outside the control of any government or central bank. Here's a scary thought: what happens when the exchange rate between gold and the dollar goes to infinity? That's not just a theoretical question, it's the very definition of hyperinflation. When it takes an infinite number of dollars to buy an ounce of gold, your paper money becomes worthless. This scenario demonstrates that, whether we like it or not, our global monetary system is still fundamentally based on gold. Hyperinflation isn't just a boogeyman used to scare economics students, it's a very real phenomenon that has occurred numerous times throughout history. From the Weimar Republic in Germany to more recent cases in Zimbabwe and Venezuela, we've seen what happens when a currency loses all credibility. In each of these cases, people didn't turn to another fiat currency for salvation, they turned to hard assets, with gold leading the pack. Now, let's not forget about silver. While gold takes center stage, silver plays a crucial supporting role in monetary systems, especially during times when we've had official gold standards. Think of silver as a substitute for gold. It's more abundant and therefore more practical for smaller transactions, but make no mistake, gold remains the primary basis for monetary value. The relationship between gold and silver in monetary systems is often overlooked, but it's crucial to understanding the potential future of our economy. Historically, the ratio between gold and silver prices has been a key indicator of economic health and monetary stability. As we potentially move back towards a system based on precious metals, understanding this relationship could provide valuable insights into the direction of our economic future. Here's a bold statement: all monetary systems must be based on gold. Why? Because gold is the origin of all prices. It's the yardstick against which we measure value. Throughout history, we've seen economies move away from gold-based systems, but they always come back. It's like a pendulum. It might swing away for a while, but it always returns to center. After economic disruptions, a return to a gold standard isn't just likely, it's unavoidable. This inevitability stems from gold's unique properties. It's scarce, it's durable, it's divisible, and it's consistently desired across cultures and throughout time. No other substance combines these qualities in quite the same way. This is why, despite numerous attempts to replace it, gold always seems to reassert its monetary role. Now, brace yourselves for some tough love. Our current global monetary system, it's on borrowed time. Think of it like the fall of the Roman Empire. It won't happen overnight, but the signs are there. When it does collapse, we'll see a return to local economies using gold and silver for transactions. It'll be a gradual rebuilding process, but it will happen. The collapse of a monetary system isn't just an economic event, it's a social and political one as well. As faith in centralized currencies wanes, people will naturally gravitate towards what they trust. Historically, that's been precious metals. This shift won't just affect how we trade, it will fundamentally alter the balance of power between individuals and governments. Some people think organizations like the IMF or the World Economic Forum will swoop in and create a new system. I hate to break it to you, but that's wishful thinking. Instead, we're likely to see regional economies forming based on honest exchange using gold and silver. It won't be centralized, it'll be organic, growing from the ground up. The idea that a top-down solution can fix a fundamentally flawed system is a dangerous misconception. Real, lasting change in monetary systems has always come from the bottom up. It's individuals and communities choosing to use money they trust, not governments or international organizations imposing a new system. Let's talk about the elephant in the room, the US dollar. Its days as the world's reserve currency are numbered. The dollar's value is tied to assets like treasuries and mortgage-backed securities. But what happens if there's a default on those mortgage-backed securities? We're looking at massive deflation followed by hyperinflation. It's a ticking time bomb. That the privileged position of the US dollar in the global economy has allowed the United States to run persistent deficits and accumulate massive debt. But this position isn't guaranteed. As other economies grow and alternative systems emerge, the dollar's dominance is increasingly under threat. If it falls, the repercussions will be felt around the world. Picture this: defaults on mortgages lead to deflation. The Federal Reserve, in a panic, starts printing money like there's no tomorrow. The result? Inflation that hits you right in the wallet every time you go to the supermarket. It's a chain reaction that's hard to stop once it starts. And the scary part? We're already seeing the early stages. This economic domino effect isn't just a theoretical possibility, it's a very real threat. We've already seen glimpses of it in the 2008 financial crisis and the economic turmoil following the COVID-19 pandemic. Each time, the response has been to print more money and hope for the best. But each intervention only sets the stage for a larger, more catastrophic collapse in the future. Now let's talk about global trade. Some people think the BRICS countries, that's Brazil, Russia, India, China, and South Africa, might shift to a gold-backed trading system. Could they pull it off? Maybe. But here's the catch: it wouldn't really cheat the current system. In fact, I believe the collapse of international trade as we know it is inevitable. The BRICS nations have been increasingly vocal about their desire to move away from a dollar-dominated global economy. While a gold-backed system among these nations could provide some stability, it wouldn't be a panacea. The real issue isn't just the dominance of the dollar, but the inherent instability of fiat currencies in general. A BRICS gold standard might delay the inevitable, but it wouldn't prevent the eventual restructuring of the global economic order. So what's the end game here? As centralized monetary planning breaks down, we'll see an organic rebuilding process. Gold and silver will become the basis for a new, decentralized global economy. It won't be controlled by any one country or institution. Instead, it'll be a return to basic sound money that holds its value. This organic rebuild won't be quick or easy. It will likely involve a period of economic upheaval and uncertainty, but from this chaos, a more stable, more honest monetary system can emerge, one based on real value, not government promises, one that empowers individuals and communities rather than central banks and governments. As we've seen, the role of gold in our economy is far from over. It's not just a relic of the past, but potentially the key to our economic future. The contradictions in our current system, from interest rate controls to the fragile nature of fiat currencies, all point to an inevitable return to sound money. Whether it's through the collapse of the dollar, the restructuring of global trade, or the organic rebuilding of local economies, gold and silver stand poised to reclaim their place at the center of our monetary system. The question isn't if this will happen, but when. And more importantly, will you be prepared when it does? This transition won't be smooth or painless. It will likely involve a period of significant economic disruption. Savings denominated in fiat currencies could be wiped out. International trade could grind to a halt. Governments could fall. But from this upheaval, a new, more stable system can emerge. In this new world, monetary policy won't be dictated by a small group of central bankers. Instead, it will be governed by the natural constraints of a gold-based system. Fiscal responsibility will no longer be an option for governments, it will be a necessity. The boom and bust cycles that have characterized our economy for the past century could be smoothed out, replaced by steady, sustainable growth. But this future isn't guaranteed. It depends on individuals understanding the true nature of money and value. It depends on communities coming together to build local, resilient economies. And it depends on a collective willingness to weather the storm of transition, keeping our eyes fixed on the promise of a more stable, more equitable economic future. As we navigate these uncertain economic waters, remember knowledge is your most valuable asset. Stay informed, stay prepared, and always question the status quo. The future of money is being written right now, and each of us has a role to play in shaping it. The path ahead may be challenging, but it also offers unprecedented opportunities. Those who understand the true nature of money and value will be best positioned to not just survive but thrive in the coming economic paradigm shift. Will you be one of them? In conclusion, the return to a gold-based monetary system isn't just a possibility, it's an inevitability. The only questions are when it will happen and how prepared we'll be when it does. By understanding the fundamental role of gold in our economy, the flaws in our current system, and the potential paths forward, we can position ourselves to navigate the choppy waters ahead. Remember, throughout history, every fiat currency has eventually returned to its intrinsic value zero. Gold, on the other hand, has maintained its value for thousands of years. As we stand on the brink of a major economic restructuring, this timeless truth may prove to be our most valuable guide. The future of money is golden. The only question is, are you ready for it?